Welcome. Today we're joined by Witbooi, Senior Portfolio Manager at Glacier Invest. We'll be discussing the difference between a stock portfolio and a unit trust fund. Equity is an essential part of an investment portfolio. It provides the opportunity to gain capital growth and income. You can get exposure to equity via a unit trust or a stock portfolio. So to begin, Wade, can you help us explain the difference between a stock portfolio and how it differs from a unit trust, specifically relating to equity?
Yeah, okay. Thanks, Justin. And as you said, both of these vehicles give investors access to capital markets, mainly around the equities of these companies they can invest in. So either directly via a stock portfolio or perhaps indirectly via a unit trust or a collective investment scheme. So the direct share portfolios actually give you direct ownership of an equity into a business. So if they were to issue 10,000 shares, you could buy one and have one claim to the future rights of the earnings or success of that business. So it's a much more direct way of accessing specific companies in an investment portfolio. A collective investment scheme like a unit trusts also gives one exposure to equities as an asset class, but instead of directly owning equities or shares in a company, you can do so indirectly via a pooled structure whereby other investors are also in the same vehicle or unit trust portfolio, accessing multiple opportunities to gain from. And the gains can be similar. If a company does well, your portfolio will do well, just according to the ownership that it has, where in the share portfolio, you can individually see the line items of the companies you own and how their share prices have fared over time.
Yeah. Thanks, Wade. I think understanding the basics is essential. And I know through experience, there's quite a big difference in the barrier to entry between these two, stock portfolios versus unit trust funds. Will you just expand a bit on that?
So with regards to the barriers for entry for a unit trust portfolio, traditionally they have been a little bit lower. So the investment amounts are smaller because you're going into a pooled vehicle where the expenses and costs are shared by all investors within that same pool. So your fixed cost as a percentage of your contributions are significantly lower than a share portfolio where potentially your fixed costs as a percentage of your contributions could materially erode the capital gain that you could make through time in the portfolio as well. So the unit trust portfolio barriers to entry traditionally have been a little bit lower. The minimum amounts that are accepted are lower. And in the example where a share portfolio or a share needs 1,000 Rand to buy into a single share, with a unit trust portfolio, you can actually buy fractional ownership into a broadly diversified portfolio without compromising the allocation. So if you have 1,100 Rand, you could invest that entire amount into the unit trust. Whereby a share portfolio, traditionally you would buy 1,000 Rand worth of one share and they have a residual of 100 Rand in your portfolio as well. What we have seen recently is the advent of, let's say, non-traditional share portfolios or stockbrokers, whereby you can have fractional ownership with lower barriers to entry. So kind of taking their lead from the more democratized unit trust or collective investment scheme industry.
I think that's a good segue to the topic of diversification, because we all hear you don't want to have all your eggs in one basket and we want to diversify. Does it differ the way you can diversify your portfolio between a stock portfolio versus a unit trust? And how does that differ between the two?
Yeah, so traditionally, unit trust portfolios are way more diverse and broad in terms of their exposure because they generally seek to cover a broad market and beat it, or seek exposure to a specific theme and broadly diversify instruments relating to that theme. So your instruments could be hundreds and in some instances up to 1,000 and beyond, depending on the portfolio you choose. Traditionally, with a stock portfolio, it's normally a smaller collection of best ideas. So a stock portfolio could have up to or around about 20 idiosyncratic ideas or specific companies. They could be broadly diversified, but on an exposure basis, on average, there's a higher degree of diversification in a unit trust as opposed to a direct share portfolio.
So we've touched on diversification and we've touched on barriers to entry. I think the next obvious question is cost. How do they differ between the two, and what do you end up paying for at the end of the day?
Yeah, so the costs associated are also similar but slightly different and nuanced. So, because of the implementation and the mechanics of a share portfolio, the costs are traditionally a little bit higher, which also comes back to the barrier to entry. So, it dissuades a lot of smaller amounts from buying shares. There's a high degree of fixed costs, brokerage, bid-ask spread, and it's way more granular in terms of how you can tally these up from an individual share portfolio perspective. On the unit trust side, you have actually the benefit of sharing a lot of those costs with other investors in the pool, thereby also lowering the barrier to entry as well. So traditionally, from a fee perspective, on average, I would probably say that unit trusts and collective investment schemes have, on average, lower fees than the fees that a client may experience from a share portfolio perspective.
So fees are one aspect we have to take into account when making investment decisions, but another big aspect that does impact investment returns are taxes at the end of the day. Can you touch on how taxes and the tax treatment of these two different type of investments are treated?
Yeah, so traditionally as investors, you're likely going to have exposure to three sources of returns, all of which may potentially be taxed. And those being capital gains, then you have taxation on dividends which you receive, as well as interest if there are interest-bearing instruments that are paid to you. So investors could, if they experience dividends, interest payments, or capital growth, be taxed regardless of the vehicle that they are exposed to, whether it's stock or unit trust portfolio. The taxes could be more immediately felt in a stock portfolio, whereby potentially there's more trading involved. So there could be more triggers for capital gains if there are purchases and sales of shares on an individual level by a professional investor or a stockbroker. On the unit trust side, potentially less friction because you are in a pool and your unit price is shared by many investors, and the unit price ultimately will determine the tax liability of the individual investor. So there perhaps could be a higher tax frequency if shares are traded and triggered on an individual stockbroker level, whereby depending on the level of frequency as well, there could be lower continual tax triggers on a unit trust portfolio. But if your portfolio does well, both investors may be liable for tax. And tax is not a bad thing. It probably means you are making money and your investments are doing well, and taxation is just a way of rotating some of those returns into the government.
So when speaking to my clients, I usually have the conversation when determining their goals with regards to tax, liquidity, and return on investment, because I need clarity on what is the return of investment you're seeking to achieve and what is the liquidity you want, because sometimes if you want a high return on investment, you have to kind of make peace that you're going to be invested for a while. And then there's also the tax that we just discussed. So on that topic of liquidity, how does that differ between a stock portfolio and a unit trust? I know they're both quite liquid, but are there some nuances to the difference between the liquidity in those two?
Yeah, correct. As you say, they are both quite liquid, but I think the nuance lies in a share portfolio. As an example, if you own shares in a company that's listed and that trades between 9 to 5 on a typical day, anytime between 9 to 5, that share will have a price and you can sell it, and that price will differ anytime between 9 to 5, depending on company events, whether there's an announcement or results, or whether external events, where the sentiment is good or bad on the day. That can vary the share price intraday. And on the unit trust side, traditionally those are priced once a day. So if market moves between 9 and 5, the portfolio will only receive the closing price at the end of the day. So from a liquidity standpoint, potentially a share portfolio can give you greater liquidity, whereby you can instruct a sell transaction if you need the money, and during the course of the day, depending on the share price, you could receive an immediate amount of money in return. With regards to the liquidity on a unit trust portfolio, it is a little bit more delayed. So generally it's about a T+2 waiting period. So within the space of a week, let's call it, holding all factors considered or constant, you could actually access both of them. That could be equally liquid. It's just that the share portfolio could be more immediate than the unit trust portfolio, which could be counterintuitive because a share portfolio you probably want to invest for a longer term, as well as a unit trust portfolio. So potentially having access to it may trigger an investor to either sell that at an inappropriate time. But both are largely liquid, so whether it's a unit trust portfolio or a direct share portfolio, within a short space of time, investors could get some money out should they have a requirement for the money.
Okay. I want to change lanes a bit and also touch on another risk factor that both of these type of investments are exposed to, and that's currency risk. Now, how does a stock portfolio's exposure to currency differ from a unit trust exposure to currency, and how can it affect the outcomes of an investor's investment portfolio?
Yeah, so currency could affect both, but perhaps in different nuanced ways. So with a stock portfolio, if you own shares in a foreign company, so as an example, let's take Microsoft shares, and you want to invest your rands in Microsoft shares, you would first have to convert those to dollars, use those dollars to buy shares in Microsoft, and if you want your money back in rands, you have to sell back to dollars and then convert those to rands. And then you would receive the difference of the performance of Microsoft share price as well as the difference in the currency. So it's way more mechanical, where on the unit trust side, you could actually buy a few units in a fund that does that automatically on your behalf. So take your rands and invest in a fund, and the fund's performance will automatically be a function of what the shares or the instruments underlying have done, as well as the currency effect on top of that. So you could feel the currency effect more directly. If the currency weakens, your portfolio could actually appreciate in a unit trust portfolio, whereby a share portfolio, it would be more difficult to quantify because you would mechanically go and have to either sell back or convert currency, then incorporate the share price underlying to determine the direct currency impact.
I think it's important for investors to understand those nuances, because we see a lot more growth in offshore exposure and people being interested in having a global portfolio when looking at their investments. So to conclude, do you have any parting wisdom that we can share to our audience? Some tips as to whether a share portfolio or unit trust fund might be applicable, or maybe a combination of the two? What do investors need to consider when choosing?
So there's no one-size-fits-all approach. Investments or finance is quite personal. So having the close understanding of your financial requirements with the help of a financial advisor will actually go a long way in determining whether a stock portfolio or a unit trust portfolio is more appropriate. If you'd like to be more hands-on and feel like your level of sophistication is higher and your propensity to accept risk, then perhaps a stock portfolio or share portfolio is for you. If you'd like to focus more on long-term objectives and have an approach that's more hands-off, that allows you to focus potentially on other things in life, then perhaps a unit trust portfolio is perfect for you. But fundamental to both is having the understanding of your personal financial circumstances and having a plan around those to determine which may be more appropriate.
Thank you for your time, Wade. This has been some insightful insights from you. I trust that our viewers have found this enlightening, and stay tuned for many more insightful interviews.